Ted, good to see you again.
Good to see you too, Moeed.
We're talking about a company here that I'm very interested in. I actually use their products and services. So I really like Peloton's products and services, use them every day. But what was really interesting was that a few months ago, they had a high, I think it was about $168 odd when I was looking at whether I should buy some shares. And it seemed a little expensive. I was using a lot of your analysis methodologies and techniques. It seemed a bit expensive to me, but now it's dropped a lot to about $108. I think that was yesterday's closing price. So really interested to hear your views on its financials and the kind of fundamentals, and whether this is whether this seems to be an expensive one in your opinion or not.
Well, you made a good point there, Moeed. So we need to be very careful that we separate our love of the product with our actual investment. And sometimes what we find is because we love the product, we want to invest. If we don't like the product, then we don't want to invest. And I think your analysis of being able to separate those two are very important. Good to hear that you're a fan of Peloton. Personally, I have to admit, I'm not a buyer of the products. I do have a bike and I like to head out into the Surrey Hills here in South London, but I'm a kind of more of a sort of, do it outside rather than sit at home and do it virtually, if that makes sense. I quite like to get out into the sunshine, although I have to admit I am a fair weather rider. I'm not sure about those really cold early mornings. Right.
Yeah.
So let's have a look at the financials. So here we go. So Ernst & Young, a good solid company, obviously sourcing out the doing the auditing. Here is the revenue, so the income statement. Now, quite interesting here. What they have done is that they have split out the revenue and the cost of sales between the products and the subscription. So when we think about Peloton, we're thinking about two very different parts of the business. We're saying, look, here are the exercise bikes that you can buy. And then also separately, you've got the subscription service where you can actually then start to kind of, sign up and race against your friends, or you can race against your colleagues, or do your sort of challenges and the online exercise classes, for example. Now, I'm not familiar with their full suite of products, but I do have friends who they sit in their basements, they rig their existing bicycles up to some kind of weird and wonderful contraption, and they still use the Peloton, the subscription, without actually buying the product. Okay, and so that's an important distinction that they've made. And interestingly enough, both of them are about the same sort of profitability. They're making about a 40% gross margin on their on the actual the subscription, and they're making about a on the actual products, and they're making a 60% gross margin on the subscription. And that kind of makes sense. The subscription service is a kind of scalability aspect. So once you've got the product in place, it's relatively easy, and it's very easy to scale and becomes very, very profitable. So looking at this company, they're making a gross profit of 836 million. We can see that in terms of the size of the company, they're basically doubling every year. So if we look at the kind of the top line revenue, they've gone from 435 to 915 up to 1.8 billion. So effectively, it's just doubling every year. Is that going to carry on doubling every year? Who knows? They're making a good profit on that, so it's a pretty nice margin. We're looking at the overall margin is, what was that, about 50%, for example. So it's all looking pretty. It's all looking pretty healthy, effectively. So there's the gross profit. Unfortunately, though, they're spending a lot of money on the business. So actually, let me just clear those drawings down, and let's look at that in a little bit more detail. So we'll just move this up a little bit. So we are looking at the operating expenses in here, the sales, general and administrative expenses. So first of all, we see a lot being invested in the sales and marketing. Kind of makes sense. It's a growing company. You know, that they're onto a good thing here. They've got to get themselves out there. They've got to be the brand of choice. People want to be kind of, you know, talking about, you know, I'm going to get a Peloton rather than I'm just going to get a piece of software, et cetera, et cetera. The admin is expanding. There's a little bit of R&D. The problem is if you add those together, you've got a loss, and they've been operating at a loss for the last few years. So they're making a profit, the gross profit. At this level here, they're making a profit and their business is growing, but they're not able yet to put it into an operating profit. And this results in a bottom line loss for the company.
Okay.
So, you know, part of the question here, you know, we've looked at some businesses which pung lots, you know, they make a loss because they're going to make a profit in the future. You know, they're burning cash in order to get to a kind of, you know, certain, you know, a certain size, kind of their optimal size, and then they can start to make money. You know, the real question here as to whether these guys can actually start to deliver. Let's have a look at the balance sheet. So here is the balance sheet. And what we notice here is, well, first of all, they've got quite a lot of cash sitting on the balance sheet. So the marketable securities, we've discussed this in the past. Marketable securities is just a way of companies parking cash. So these are actual bonds, and effectively we can think about them as another form of cash. It's very easy to sell them. So they got about 1.7 billion in cash, significantly up from the previous year, and that's partly due to their flotation. We also see, we just move this, scroll down a little bit towards the bottom of the balance sheet. We can see things like, for example, they've got these assets, so right of use assets and long-term lease liabilities. Now, I'm not sure exactly what that is or how their business is changing, but it looks like this is kind of, you know, that they're hiring machines. So maybe they've got some centers, they're hiring these machines, and they've got leases sitting next to them. Now, one thing, in fact, let me just go back to the P&L before we go on, because this did jump out at me, which is just a little aside, but made me smile, I have to admit. So if you've got your maths hat on, Moeed, what's 195.6 negative, add back 0.1?
195.5.
Yeah, so it's not 195.6, so they can't add up. Now, you know as well as I do, it's going to be a rounding in there, but quite frankly, you know, if you're going to produce the results of a company, it should add up. Okay, so that's a kind of, I thought that was quite an entertaining a little aside there.
That's
okay?
Interesting. Does it have any implications? None that you can think of?
None at all. It's a rounding issue. It's
okay.
You know, if you put detailed numbers in, I mean, obviously, you know, these are rounded to the, I think these are in millions. Yeah, so they're in millions. So obviously, that, you know, if you account for them down to the nearest cent, you're going to have them absolutely 100% perfect. But it was just an interesting one there. So we're back on the balance sheet. So a couple of things to notice on the balance sheet is, first of all, so in the previous year they had this redeemable stock. So this is effectively, and we've seen this before, this is effectively this is a form of kind of, you know, this is a kind of hybrid debt equity instrument. So, you know, effectively what happens is that on flotation, this has been translated into actual proper equity. So we can kind of, you know, think about that as a kind of somewhere between debt and equity, which is interesting that they don't include it in the total liabilities, but they don't include it in the shareholders' funds. So I've actually just classified it into the liabilities when I'm looking at this balance sheet, because it's, you know, we've either got to treat it as one or the other. We can't, you know, leave it out effectively. So you'll notice they've got a negative balance sheet, but then they've gone to a positive balance sheet, and that positive balance sheet is really driven through here, which is the share, the share issue. That share issue is reflected in the cash flow statement. So here's their cash flow statement. Quite interesting on the cash flow statement. We notice there's a big number here. So the stock-based compensation. So a lot of the cost of running the business, paying money to staff, a lot of them are getting shares in the business as a way of compensation. You know, and they're hoping that the share price is going to go up. They're going to make lots of money, and they're all going to become, you know, multimillionaires at some point in the future. And down here we see, so here we see the proceeds from the share issue. So effectively, this is a kind of, you know, them raising money by floating on the company actually raising money rather than individual shareholders being able to sell their own shares. Now, one thing I will point out here, Moeed, which I think is quite interesting about their about their business model. So if we go back to the income statement, what we see is that, you know, they're selling fitness products, but they've also got a lot of subscription. And some of that may be on a monthly basis, but they'll have an incentive to people to buy a yearly subscription. So subscribe to our services for a year. And if you subscribe for a year, what you can't do is you can't put all of that revenue into your profit and loss account, because the kind of subscription revenue that relates to next year, you actually have to show in the next year's accounts. What this means is that the company is very good at generating cash, but it can't show the revenue in the profit and loss account until it actually earns it. So what we see in the balance sheet is this thing here, which is customer deposit and deferred revenue. So this number here is effectively either I've put a deposit down on a machine and I'm going to get it sent to me, or probably more likely it's going to be revenue. I paid a subscription, but I haven't actually used that subscription because it relates to next year effectively. So I thought that was quite an interesting that was quite an interesting amount. So we're recognizing that, you know, we have deferred revenue. It's good for cash flow, but it is appearing on the balance sheet as a liability. They're not going to pay it out. They owe it to next year is the way to think about that number there.
So just interestingly for our viewers, that could be seen as one of the indicators for whether the business is what the business is going to produce next year. Like I say, it's not the whole thing, it's just one of the indicators that gives you an insight into next year's performance.
Yeah, effectively. I mean, you know, you can see that the numbers are growing, for example. So this is just, you know, but then we can see that they're growing at the top line when we actually look at their revenue. So we can see the revenue is growing as well. So that growth in customer deposits is reflected in the growth at the top line. So effectively, it's saying that, you know, this is money this is sales effectively that are going to appear, you know, in basically in here for 2021 effectively.
Yeah.
So the key thing to kind of realize though is that for this business, so for example, they're making this loss in terms of profitability, but they're actually generating cash. Okay. So it's a very strong cash generating model, and a lot of that is due to this number here, which is the customer deposits and deferred revenue. So effectively, they're getting the cash in. Okay, so they're getting lots of cash in today, but they don't actually have to deliver the service until tomorrow. So you'll see things like telcos are another example of that, where, you know, think of all the prepay SIM cards they sell. That's lots of cash today, and then I'm going to deliver the service tomorrow. So it's very, very very good for the cash flow aspect of things like telcos, and it really helps to kind of relieve the strain on the cash flow effectively for a business. Okay, so there's our business. Let me just clear those drawings. There we go. So there's our business, and kind of, you know, it's growing. It's not making a profit, It needs to start making a profit at some time soon. I'm not convinced it's going to carry on doubling and doubling and doubling again. I may be wrong here. Maybe it's going to be the go-to, way of, cycling. But I kind of think we're coming out of lockdown. The sun is shining. Quite frankly, I'm going to be on my bike. I'm going to be out in the hills. So, I'm not sure that, is this a lockdown company? That's kind of the question I guess I'm asking. And your point about the kind of, the recent performance in the share price maybe reflects that aspect. So here is the share price. So we see that they're trading on a market cap of 31, basically 32 billion dollars, which seems quite high because the balance sheet is just over 1.5, it's less than $2 billion. So it's a lot of goodwill, and that goodwill is very much jammed today. It's an internet company with a subscription to their services, although they're obviously selling the actual machines as well. And so a P ratio, this was this morning, 216 times earnings. Well, again, if we look at the profit and loss account, they're making a loss at the moment. So, 216 times, I'm not sure what earnings that number is actually based on. Hence, I put a question mark next to it. It's making a loss. I'm pretty sure it's going to make a profit. It will make a profit. I'm not sure it's going to make a massive profit. And I'm also not convinced that it's really gonna it's a premium product. It's not a mass market product. At least that's my perception of it. Maybe they can get the revenue up, but they're going to be competing against Garmin, Strava, for example. So a lot of these companies are already in that kind of space. Can they scale the revenue side? I don't know.
Yeah, interesting. Yeah, it'd be interesting to see what other business models, what other products they're able to produce, because that's going to be an indicator of whether, in my opinion, whether that price is justified. I like I said, I don't own shares in the business, but I do use the products. I personally see that they are creating a great future. The pricing is actually very competitive when you think about it, compared with going to a gym. And I've done both. So I personally prefer Peloton in that respect. I think if they use that data in the right way, then they might be able to create great products, just like we've seen Deliveroo, for example, start to use their data to provide some very, very specialized products and advice to some of the restaurants out there. What do you think?
Quite possibly. I mean, if you're going to buy a Peloton bike, it's a big investment. They're expensive people to get. You've got to have somewhere to put it effectively. I quite like going to a gym. Psychologically, it kind of takes me away from being at home. I don't really have the space to sweat all over my own floor. There's a kind of a social aspect to being at the gym. It's kind of, but maybe that's just me, and I have to be careful that I don't kind of, project my own lifestyle onto other people. I'm just, it's quite an interesting company here. It's a premium product. My understanding of, when they were going around looking for funding right at the very beginning, lots of people were going, no, your business is not going to work. We're not investing, but by the way, I quite like to buy one of your products. So, it was quite interesting. It was a very desirable product, but people weren't convinced by the business model. So, we may be wrong. It just, to me, it looks very, very expensive, and if it's very expensive, it looks much higher risk. It's not an obvious, it's not shouting buy at me, for example. It's not cheap. Therefore, I'm not convinced that, this is where, I might buy, a little bit because I like the product or whatever, but I'm not absolutely convinced by it. Then, it's a bit like, think about Apple, for example. If you sort of bought an iPhone 6 and thought, oh, this is pretty nice product, I'll buy a few shares in the company, you'd have done very well, even if you hadn't done your research. I'm not convinced they're going to be the next Apple. I'm prepared to eat my words, though.
Yeah, so a good debate here, Ted. And what are your thoughts, viewers? Do you think this is a business that is going to grow and it's going to be a great investment now, what are your thoughts on the fundamentals that we've shared here? So like, share, subscribe, but please do share this amongst your community. Let's see what everyone else thinks. So Ted, thank you. This is a really interesting one, personally for me, because I use the product and I looked at the shares earlier. So great to hear your expertise on the fundamentals. Thank you for that, Ted.
Great speaking as well, Moeed. Thanks a lot.